Is this just a correction in the bull market? Are we seeing a proper correction? Should we brace for impact? Or are we going higher? I think gold is not really decided where it wants to go just yet. And I'm really excited to have Gary Wagner coming on the program today to help make some sense of what is happening in the markets. A lot of influences sort of hitting the gold price, being it the Dixie, being it the Fed, or market commentators suggesting that the Fed might actually go to 8% in terms of the Fed interest hike or rates. And I think that's causing some uncertainty in the market. And like Gary, I'm going to quote you because you mentioned in the pre-chat, it's a push and pull effect. It feels like the market doesn't really know where it wants to go. Gary, with that being said, awesome to have you back on the program. It's great to see you, my friend.
Thanks so much for having me.
Absolutely. And Gary is like, I was going to ask you, like, how's the weather? It's a question a friend of mine who's an elementary school teacher asks his kids in the morning to gauge how their mood is. How's your mood? How's the weather, Gary?
Well, from what you've told me, we both have beautiful blue skies. Here it is sunny. Apparently, where you are is a little bit colder. But typically, during this time of the year in Hawaii, it is our rainy season, but we're still looking at between 70 and 80 degrees Fahrenheit. I don't know how to translate that into Celsius.
Okay, like how's the weather changing? Now I mean the gold price over like the mood and sentiment over the last few days. Because I was looking at the market also late last week, and we ended down. We were close to like hitting $1,800 coming from higher, and went into the weekend on red pretty much. But now I'm looking at my screen; it's all green again. The commodities actually are all green today. What has changed, Gary?
Well, we have to put this into context in terms of a bigger picture. And the bigger picture I'm looking at is beginning in November. We had a multi-month correction after hitting the highs at the end of last March, moving down, taking gold to just above $1,600. I believe around $1,621. We did that on 3 occasions. I've been labeling it as a triple bottom. From there, we had a tremendous move to the upside with only one shallow correction going from 1621 to 1974. So that's in terms of a rally. And I know you've been looking at gold for probably as long as I have. A good healthy rally is 100, maybe 200, $225 US. And this was double that. So at some point the market had to correct, and it did. Hit a top at 1974 and it came down. The key to what I was looking at is technically based. I looked at this move from 16 to almost 2000, 1974, as a single move broken into 2 parts. The first one traded to, I forget the high, but it came back down to 1719. So I'm measuring 1719 up to 1974. And when I do a Fibonacci retracement, the 61.8% retracement occurs at $1,815. So as we approach that, I realize that it doesn't necessitate that it will find a bottom. And I have to acknowledge that the markets fundamentally are headline driven, but it is a point that we want to look at to see if there's any pivot or any support coming into the market. Yesterday's low was 12. Today's low was 1810. And we've had 2 strong up days now, really the first ones that we have seen since that correction began. So I think what we're witnessing is a market that was honestly oversold. And in terms of the background as to why that's happening, that's another story. But at a certain point, you get traders either pulling profits or it becoming inexpensive enough where it's perceived that this is a dip to buy. And it's a combination of all of those things, because fundamentally, the Fed continues to put pressure on raising rates, contracting the economy. And that, of course, creates negative or bearish undertones for gold, whereas higher inflation is positive. And that goes back to what we were discussing just before the interview. You're getting this push-pull effect. Typically, you don't have both forces hitting the financial markets concurrently, and that's what we're seeing.
Yeah, no, gold is starting to sort of, fight against the bond yields as well. Like if I look at the treasury yields, like for me, for example, it jumped out at me is the 1 year 5% yield. That is tough to beat as a for gold investors, depending on like what your motivation obviously is in buying gold. But that's a yield tough to pass up for any investor, I believe. Looking at this now with inflation still being sticky and not really wanting to rescind here, is gold back to being a bit of a safe haven investment as well, back to diversifying? Because I see the Dixie coming down as well.
Absolutely. I think that it's always going to be that inflation hedge, but it wasn't. It was very attractive when real yields were 0.5%, 0.25%, 1%. Once fixed guaranteed yields are above 4%, as you were saying, it makes gold much less attractive because if you've got a guaranteed 5% return, why risk it considering that in February, gold moved down about a 5%. So exactly the opposite of what the real yields were. And that obviously takes some thunder out of the power of gold itself. And as I said, I think the primary thing we're witnessing is investors looking at gold as being oversold and an opportunity to buy the dip.
Buy the dip. That's awesome. I like that that term is now making inroads in our industry because we avoided it like the plague back in, what was that, 2020, actually, when all the meme stocks were hyped and you were supposed to buy the dip whenever they dropped, right? Um, Forecasting is a little difficult, of course, but like where do you see things headed now? Like we're in a correction of a correction, it feels like. Where do you see things headed?
Um, First, short term, I believe that we're getting a bounce and it's not a dead cat bounce. In other words, it will have some momentum. My target is, excuse me, my target is just above the 50-day moving average in terms of the low end. I think that's around 1866 up to maybe 1890. That's my low end target. I think at that point there could be pressure. We could see it come down. If it surpasses that, the high target I have is just above 1900. However, I believe that following that, we will get one more solid correction, taking it either back to the recent lows, which we now have as 1810, or slightly below. However, I have a line in the sand at 1791 basis the futures contract, because that was the peak of the first leg of the rally. And typically, if it moves below that, it can't be technically conveyed as a correction. Rather, it means that we could be seeing a pivot from bullish, meaning going from 1621 to almost 2000, to bearish. However, if it holds 1800, 1790, which for now it has, that's truly a correction. It is deep. A 61.8% correction is a very deep correction, but it's absolutely accepted in the terminology of what a technical trader looks at for a correction versus a pivot from bullish to bearish.
Absolutely interesting. Like I'm not a technical guy. That's why I always enjoy having conversations with you. Like for me, a technical is like a lot of like teacup reading, and I don't mean to diminish what you're doing, right? Or
No, no, no.
reading the tea leaves, right? So, that's why I love your commentary there. But Gary, like looking at it, we're 20 days away from the next FOMC meeting, and it looks like, and I've been checking Fed Watch Tool lately, like almost daily. It looks like we might be trending towards a 50 basis point hike again.
Well, according to the CME's Fed Watch tool, which is what we both watch daily, the probability of a 0.5% or 50 basis point hike is now up to 30%. Just the other day, it was at 23%. But at 30%, it means there's a 70% probability of a 0.25%. My personal feeling is, first, we've got two key reports coming out. On the 10th, we have the jobs report, and then March 14th, we have the latest CPI. And depending on how those reports unfold, will have a lot to do with the final decisions of the Fed. I think ultimately what they're hoping to do is what they stated at the end of January, which is there's going to be pain. We've told you that since August. but we are going to continue to raise rates, but we're going to slow the pace down. Because remember, we were living through consecutive 75 basis point rate hikes. There was like 4 of them. And that was till December when there was a 0.5% rate hike. And then in January, they went to 0.25%. And it's funny when a 0.25% rate hike is perceived as dovish, but in fact, that's how they looked at it. I think that in a textbook case, what the Fed wants to do is have 3 more rate hikes and spread those across the consecutive FOMC meetings, taking Fed funds rate to between 5.25 and 5.5, which is an uptick from the 5 to 5.1 that they were projecting before they came out with the dot plot in December. So they want to slow the pace down, one. The second thing that's critically important is there is a good month or 2-month lag between when the Fed raises rates and they see the overall effect in the economy. So the day they raise rates, it's going to take some time for that to work through the system until we see the ultimate effect. And they haven't let up on the gas pedal, so to speak, since they started raising rates a year ago, March. Now that it's March, I can say that. So we've had 8 consecutive FOMC meetings that all resulted in rate hikes. That's kind of unheard of. I don't know when, historically speaking, we would have to go back to see that kind of Fed activity with that consistency of rate hike all across the board. So they're probably going to continue. The likelihood is now 3 rate hikes of 0.25% rather than 2 rate hikes of 0.25% because they've raised their initial target where they want Fed funds rates to be.
Glad you mentioned the 3 rate hikes there, because I'm trying to figure out where gold lost momentum and why it gained momentum in the first place back in November. Because I think in November it felt like the gold investors like us we're trying to be smarter than the Fed. We tried to smell out or sniff out a pivot early on, and that's why I think gold rallied to a degree, right? And we were caught off guard a little bit. Right, we were at, as you said, 1970. Now we retraced back to 1800, which hurt sentiment a lot. Again, a lot of in junior mining and with junior explorers. Financing windows are shut again. It's dead out there. Unless you're raising big money, you're not raising any money at all right now. Maybe as a question, let me formulate it as a question. What have you learned from November? Like when we tried to sniff out or like be smarter than the Fed, right? And then we tried to beat the Fed, which is impossible.
Well, the way I look at it is it's very difficult to be smarter than the Fed. On one hand, it's very easy to also because I'm not so sure they're transparent. But to the point is that market participants are always looking forward. Where do they believe that rates will be in 6 months from now? When we're placing a bet on a mining stock is what their production, what their net output is going to be, what their income is going to be 6 months down the road. They're never looking at where it's currently because then equities would not move if that price was stagnant. So they're looking out in time. The big mistake I believe that was made by the average or market participants as a whole wasn't so much trying to outguess the Fed as hoping or believing and I can't put it in terms that aren't harder than that, although I want to, not on air, but they were under a false assumption that the Fed would back off before they got inflation to what they believe is acceptable, which is a whole other issue. They're targeted 2%, which I believe is absolutely unrealistic. It won't happen. But they were under the belief that the Fed would play chicken, it was unsustainable, and that at some point this year, they would back off and go into a pivot where they start cutting rates. And that happened concurrently as the Fed narrative was, we're going to continue to be hardcore. We're going to raise rates. We're going to do whatever it takes. I mean, there were so many different catch lines that different Fed members used to try to illustrate our resolve is strong. We're not going to back off of this one. And think about it this way. Jackson Hole Economic Symposium, I believe August of last year, is when Chairman Powell first delivered what I call the pain speech. That, look, it's going to be tough for months, maybe years to come. You will experience pain. We feel that pain. Of course he does. But you have to realize that they didn't want inflation that got to a 40-year high to become so entrenched they couldn't do anything about it. The other thing I believe is that if you look at how interest rates, or not interest rates, but inflation ratcheted up in 2021, it was under their 2% target up until about March. And the following month, I think it went to 2.6, but the Fed did nothing. And throughout the remainder of 2021, they watched it go from like 2.6 all the way up, I think, to about 7, finally topping last year, 2022, at 8.5 when they actually implemented their first interest rate hike from 0 to raise it by 0.25%. If they would have acted when inflationary pressures a year prior to their first rate hike were at 2.6%, they could have easily tackled it by raising rates to maybe 1%, or even if they had to match it at 2%. But to let it go to 8.5% was a huge mistake. And because of that mistake, they have been in a reactive mode rather than a proactive mode for the last year, year and a half. And that's the problem the Fed is faced with. And so now the dogma is we're not going to let up until inflation's at an acceptable level. I think 3 to 3.5% will become the new 2%. I think a 2% target is unrealistic given the geopolitical climate, the war in Ukraine, other things that are going on, the issues with China and the US. We're not going to see 2% inflation, I don't believe, throughout this decade. Could be wrong, but I think it's unrealistic to get there. And I think 3% wouldn't be all that bad considering we were at 9.5% CPI, core was at 7%, and now we're down substantially. So that's the issue that I think that the Fed's been tackling with, which is to react to a blunder they made years ago and trying to play catch up.
Yeah. No, just trying to understand the macro picture just a little better. Besides the housing market, nobody's screaming yet at the top of their lungs that there are issues at hand with higher interest rates. Like I haven't heard a lot of complaints from any other sectors. Of course, I can look at all the housing data, and new builds are down. Cost for new construction is down. Every single indicator in the housing on the housing side is down. Like, do you see any other indicators sort of signaling, okay, the interest rates are starting to have an impact here? We need to monitor this.
Again, I think that we haven't felt the full impact of taking rates to 0 to where they are now, which is 4.25 to 4.5. Secondly, in terms of the American consumers, middle class, the administration pumps so much money. I was receiving checks for $1,400 and at a time when I really didn't need it. But the point was I wasn't the only one. Large corporations were getting tremendous amount of funding from the administration. The middle class, which part of them needed it and part of them didn't. Of course, the lower class absolutely needed it just to sustain themselves. But there were so many trillions of dollars pumped into the system. The latest data I've looked at says that a lot of that money is still parked in savings account or in equities or in something. So that's why I don't believe that on an individual level or consumer level, they've felt the pinch of that, except for housing. But in housing, people took advantage, those that had properties refinanced when interest rates were down near 0. To buy something now becomes very difficult. So they've decided we'll stay in the current property. And then individuals that are now priced out are looking into the rental market. So it doesn't affect them that much. Corporations will always pass on those interest costs to consumers. So what we see, for example, is that on the consumer side, they'll raise prices, but more importantly, they change their packaging to whereas it used to be a 12-ounce package, it's 10. So they've got ways of kind of folding higher levels of inflation and the interest rates which they're passing on to the consumer that are not as transparent as raising the price of a widget from $2 to $4 or $2 to $3. they're a little bit more nefarious in terms of how they're passing those costs along.
Shrinkflation is the key word here. I love that term. There's a few posts on Twitter daily just showing packaging that sizes have just shrunk. it's,
Yeah,
it's really
absolutely.
interesting. Gary, maybe sort of to wrap up as well. We haven't talked about silver at all, but it has been dragged down by the gold price. It seems is gold price the main factor on silver, or the main the main anchor, or the anvil that's pulling it down?
I think, excuse me, I think personally there's been a disconnect between the tandem moves we see in gold and silver that we saw previously 4 or 5 years ago. The first disconnect that was obvious is the point that gold went to a new all-time record high and silver topped out at 30 rather than 50. So we've seen silver not have the ability to keep up with gold in terms of an inflationary measure. However, I think that long term, the demand for silver is greater, especially if the world's moving into green technologies, solar. All of these things require a lot of silver. And so I think that the industrial component in silver is what's been the greatest factor in terms of pricing. And I think that as equities were down during the period that they were, the demand for silver was down. And so it's less of an inflationary hedge and more of a semi-precious metal that's highly used in industry. And so there's been that disconnect. They're not as tightly intertwined as they used to be, I guess would be the best way I could characterize it.
Yeah. Do you have any price predictions as well for silver? Or is like really just gold for you?
No, no, no. I do. Whether they're right or wrong, we'll see.
Like I
My
forgot to ask you beforehand. That's why like I'm a bit careful in my approach in the
no,
question.
not a problem. In terms of gold, my belief is that by the end of this year, by the end of Q4, it will have a new all-time record high. I was looking at 23 possibly, but I've kind of moved that forecast down a little bit, but I still believe it will be 2088. 2100 is my current target. In other words, a new high is what I'm looking for. Now, silver, as I said, is a different animal. The key right now is what does it do at $30? Because that's the new hard ceiling in silver. It's no longer 50. And if you look at the historical charts when silver ran to 50, it was a blink of an eye and it was gone, right? It went to 50 and 3 days later, you're trying to sell your silver and you're getting $36 for it. My year-end target is about 40, say 38 to 42 in terms of silver. I would love to think that if I'm correct about gold going to a record high, that silver does that, but the record high is 50 and it hasn't hit that in what, 5, 6 years or more. So my target's a little bit lower, 38 to 42 in silver, new price high in gold by the end of Q4.
Wow, fantastic, Gary. If I hope it comes real. Like I woke up this morning, I was just looking at the news, and I was like, something needs to change. Like I have to tell you, I wasn't excited about what was going on in the markets, and getting up was difficult. I have to admit.
Well,
So
you can always look at the other side, though. I woke up the last couple of days and said maybe the correction, at least for a moment, is over. Because what was really getting to me is the fact that the way price movement in gold has been happening hasn't been finely tuned to Fed action or inflation or interest rates. It's been so forward thinking, and that thinking has been so optimistic. It moved it from 1600 to 1974. That's a tremendous move. What, almost $400 move, basically double of what we consider to be I including you, but you can comment on that. 150 to $250 rally in gold is robust. At least that's what I've seen and what I have internalized. So to see a gold move almost $400 is unheard of, except back in 2009 and 10, as it moved to it went to 1,000, broke to 700, and then just moved up like a rocket ship to 1910. And at 1910, I thought it would go to 2000. And of course, I was really wrong then, because that's when it crashed, but it was an all-time record high back then.
no, volatility has been crazy lately as well. So it's not been good for my nerves. Fantastic. Gary, it was
Absolutely.
great to have you back on the program. I've always enjoyed chatting with you. Like, a tremendous honor to have you on. Where can we find more of you? I think we have your domain sort of down there on the screen.
Yeah,
Hold on. There, thegoldforecast.com.
that's our primary domain, and that's for our premium subscribers. That's where they'll log on to. We do have a YouTube channel at the Gold Forecast on YouTube, and there we've used it as a library. So we've got every video we've ever done since 2010. So about 2,000 videos that are accessible at no charge. Of course, the current ones, we don't put them onto what I'll call our backup server, meaning YouTube, for about 2 weeks, because that we reserve for our premium subscribers. We do have a 14-day free trial. You can try it out for free for 14 days. If you see that it will have value for you, keep it. If not, just send us an email and say stop, and you won't be billed ever again. So that's a really good way for people to try us out if they're serious about their investing in gold, whether it be physical accumulation or trading the futures markets.
Fantastic. Gary, tremendously appreciate your time. It's great to see you again, and we'll catch up again very, very soon. Thank you so much, Gary.
Aloha and mahalo, as we say.
Mahalo, Gary. Yeah, exactly. Appreciate it. Thank you so much. And everybody else, thank you so much for tuning in. Really, really interesting conversation with Gary's. Like, it gave me some cause for optimism here on the gold side. Because quite honestly, I was a bit confused about where the gold price was going. And we said it was a bit of a push and a pull kind of situation for me as well. Because I wasn't really sure who was pulling gold down or what was pulling gold down. And I wasn't really sure what was pulling gold higher the last couple sessions as well. So really appreciate Gary's input. If you enjoyed this conversation, please subscribe to the channel. It's the square box here. It says subscribe on it, because I noticed that 85% of you are not subscribed that are watching. Let's change that. I really appreciate it. And we'll be back with lots more great content in the coming days. Thank you so much.